Hello everybody, and thank you for joining our fourth business continuity planning webinar. I'm pleased to be joined today by five colleagues: Stephanie Pote, who's a HR advisor; Greg Taylor, partner in financial services; Laurence Whitehead, partner in our corporate finance team; Georgina Eason, partner in restructuring and recovery team; and Bhatti, who's a research and development specialist. We're going to quickly run through with a focus to really thinking about how we kind of move forward from this point, and how we with the plans that we may get at the weekend in relation to moving out of lockdown and maybe starting to sort of reopen the doors and trade again. It's thinking about some of the practical implications, it's easy for me to say, and planning to unfurlough employees. An update from Greg, obviously, on the funding, the CBILS and CLBILS and other funding options to help get businesses up and running again. Venture capital and private equity options to consider, and for the Future Fund scheme, which is due to be launched in May. Aspects of deferring your filing of your accounts, pros and cons, changes to wrongful trading rules, and practical advice and considerations for directors. And then how to safely maximise research and development and its interaction with other government support. So quite a bit to get through, so I'll crack on. Just very quickly in relation to the coronavirus job retention scheme, there isn't a lot to report from last time. It's kind of been launched, the portal's been going, things have settled down a bit. Just a few points of clarification that have come out from the government, really. One is that coronavirus job retention scheme grants are not classed as state aid. So that might become relevant at the moment or in the future as you think about additional funding you may need to apply for. So do I tick the state aid box or not? Well, CJRS is not state aid. Employees can still undertake activities related to union or non-union representative duties. So that might become important as we move through furlough and unfurloughing, so where they're involved in collective representation of employees or other workers. Just a point of caution that in the guidance to employees, the HMRC have said that they can play a vital role in reporting fraudulent claims, because those claims affect the provision of public services. So if employees are concerned about employers claiming but not paying the right amounts to employees, employees being asked to work whilst on furlough, or awareness that any backdated claims might be made when people were working, then they're asking those to be reported already. And I think part of that is just to consider the backdrop that as of midnight on the 3rd of May, the CJRS scheme had actually already been used to support 6.3 million jobs, 800,000 employers, and more than £8 billion in claims, many of which we know have already hit people's bank accounts. I've not really heard of many that haven't. Now, that's just unsustainable. That's about the same numbers as if they were funding the NHS. So changes have to be made. We know that the government is looking to announce maybe on Sunday what's going to happen in relation to easing of lockdown. And also that the Chancellor has also said that the CJRS will not reach a cliff edge, and he's working to figure out the most effective way to wind down the scheme and to ease people back into work in a measured way, but still being covered, obviously, by the government. So there'll be quite a few things for businesses to now start to focus on and consider how we unfurlough workers, but maintain operational optimism and performance, but also in a fair way. What we need to do to assess business activity and staffing levels post at least the 1st of July, maybe even from this point forward. Consider how we can remunerate people when the JRS scheme isn't available anymore, and what maybe the additional costs are of the potential alternatives of remunerating people where income's low, even remunerating through and funding a downturn in staffing levels and redundancies. What's useful is that CJRS can still be used whilst you may be going through a process of making employees redundant, so they can still receive furlough pay. CJRS isn't there to fund redundancy pay itself, but maybe could at least be used as part of the funding for any kind of notice pay. So just some things to think about from CJRS, and then some of the practical HR implications of planning as we move out of to unfurlough people. I'll hand over to Stephanie Pote to cover that from a HR perspective.
Thank you very much. So yes, I'm going to be talking about un-furloughing. Not even sure that's a real word. Starting to get back to normal, human resource planning and potential redundancies, and consideration and permanent contractual changes going forward. So as Nigel said, we don't know how or when we'll be able to come out of lockdown. We were hoping for some clarity later today. Looks like we're going to have to wait until Sunday. I'm sure you're aware there's been a lot of conjecture. What we do know is that we will not return to normality overnight. There will be a recovery period, partly dictated by the measures the government requires us to have in place and partly by the economic landscape we now find ourselves in. Return to work will presumably be on the basis of social distancing still being maintained, so workplaces would need to be arranged to accommodate this. Masks or face coverings may have to be worn. Use of hand sanitizer and anti-bac wipes will undoubtedly be requirements, and you'll have to have all these in place before your employees can return. And these requirements are going to have to be reinforced, probably by the use of disciplinary action for repeated breaches, because failure to comply is going to have to be considered to be a serious breach of health and safety. You also have to give consideration to communal areas. Hot desking, is that appropriate? Use of lifts. You might look at staggered start times and break times, and in fact, these might be government requirements of a return to work. They'll also insist any of your employees have to travel by public transport, so they're not crowding onto overcrowded buses or trains. Or you could implement a phased return, so some employees return earlier than others, but you need to ensure that the reason for this is communicated well to all your employees. You might need to have employees separated by protective screens. You should take action to minimise the number of things that employees need to touch. So, for example, having doors left open. You should consider if and how employees can safely continue to use kitchen facilities, or if making drinks and heating up food is going to have to be prohibited. Where your employees work out on client or customer sites, you're going to need to consider if this is still required. Obviously, in many cases, it's essential to the role. And if so, you're going to have to ensure their health and safety whilst they're there and your duty of care towards them. We're talking about getting people back to work or getting people back to some semblance of normality. There are going to be three categories of employees: those who continue to come to work, those who worked from home, and those who were furloughed. And some of you will have employees in all of those categories. For those who continue to come to work, recognise their commitment. They've been the mainstay in keeping your business running. They're probably already used to working in a different way with some of the measures we've just mentioned, so you can call upon their experience and ask them to mentor those who are returning. Those who've worked from home, they'll have had some level of continuity, although you have to recognise it's not a normal working from home situation. It wasn't a contractual agreement, it was forced upon them and upon you. Acknowledge they've continued to work in very trying circumstances. Don't be too critical if they've not been 100% performing. And then the furloughed employees, they may well feel they weren't wanted during the crisis, they weren't key to the operation of the organisation. And it's important to emphasise to them that they are integral to the future of the business. It was the nature of the work that led to the decision to furlough them, not the importance of their posts going forward. In terms of unfurloughing them, you will hopefully have been keeping in touch with them during the furlough. The time will come to contact them and explain that they are needed to return. Thank them for bearing with you and set out the arrangements for their return to work once you've decided on how that's going to be. You probably need to conduct some sort of reorientation, reinduction with them on their return to enable them to get back to work. Don't expect them simply to pick up where they left off. You may unfortunately find some resentment between your different categories of employees, those who felt they were undervalued, equally those who felt that those on a furlough on some sort of cushy number. Just be clear, it was a difficult situation. It's a cliche, but it was unprecedented. There were no rules in place as to how you were supposed to deal with it, and you did the best you could as events were unfolding. If anyone feels they've genuinely been unfairly treated, then refer them to the grievance procedure, handle it in the normal way. Either resolve it if there has been some unfair treatment or close it off. Don't leave those issues to fester. For all your employees, you're going to need to set out clear work plans and objectives, not to be harsh or dictatorial, but to give them a clear idea of what they are meant to do now and ensure any training requirements are met. Obviously, some are going to adapt to this better than others. Encourage communication at all stages, give them a clear line of contact if they're unsure as to what is expected of them or have any concerns, and explain there'll be no judgment on anyone who's struggling or who has questions. And have a contingency plan in case there is a second wave of lockdown. You will have had to have reacted very quickly when the current restrictions were announced, probably made a lot of decisions as you went along. Try to take learning points from these, put steps in place to ease the transition back to lockdown if that becomes necessary. Human resourcing and redundancies. If you've not already done so, you should now be looking at your human resource planning. It's obviously more difficult with all the unknowns, but in the main, depending on your sector, businesses are not going to return to levels of operation immediately. It will take some months, maybe even years before anywhere near back to being normal. So consider the impact of the virus on your business, your likely future in demand and supply, and what levels of staffing you will need going forward. And assuming this is a reduced need, look at all the alternatives: short-time working, staggered shifts, pay reductions. Remember also, many of your employees will have accrued holiday during lockdown. Now that could be used during the recovery period, so you're providing them with full pay whilst you're unable to have them return to work. You're probably aware employees who've not been able to take the holidays during the pandemic are going to be legally permitted to carry 4 weeks over into the next 2 holiday years. That doesn't mean you can't require them to take it now if it suits you better. But even with all those measures, some of you are unfortunately going to have to make redundancies. CIPD survey found that between 11 and 49% of workforces are likely to be affected. And whilst the job retention schemes provided a short-time alternative, there's no doubt that redundancies will happen. So consider the structure of your organisation and its departments, which are going to be able to resume or continue working, which are going to find it difficult, which have become virtually obsolete. Do you have any luxury roles that were fine whilst the sun was shining and business was booming, but now you could manage without them? In some cases, you'll find you almost have to pare back to the bare minimum. Consider yourselves almost as a startup business. What are the basics you need in order to operate? Said before that you need to be reassuring people returning from furlough, but if you're looking at making redundancies, some employees may in fact not return, or if they do, it'll be for a short time. Whilst you're going through a consultation, still remember the human aspect of this as well as the legal. You need to communicate that you're having to make difficult decisions for the sake of the longevity of the business. It doesn't reflect on their performance or loyalty as an employee. And of course, despite the pandemic, employment legislation still applies. You still need to set out a robust business case and commence consultation. Due to COVID-19, full stop is not going to be enough on its own. You need to set out what the impact has been on your organisation, what you envisage the future impact to be, and why this is leading to your proposal to make job losses. You then enter into consultation in the normal way, taking social distancing measures into account. And remember, if you're proposing to make 20 redundancies within a 90-day period, collective consultation applies, along with a minimum consultation period of 30 days, 45 if you're proposing 100 or more. Whilst it's going to be more difficult than normal to predict if a second wave of redundancies might be necessary, which then pushes you over the 20 limit, if you think it could be a possibility, undertake collective consultation from the beginning. As you're probably aware, the job retention scheme was extended to the 30th of June in order to avoid employers having to commence collective consultation in the middle of April. That requirement will now be middle of May, which is next week. So if you want the process to coincide with the end of the scheme, unless there is a further extension. And as Nigel alluded to, there will be a further announcement. The scheme will be scaled down rather than ended overnight. There might be a reduction in the percentage of pay that the government will subsidise. It might allow people to return to work on reduced hours and get some sort of subsidy, but we don't know at the moment. Clearly, the benefit of coinciding with the end of the scheme is that you can continue to claim the 80% of pay whilst employers are serving notice. And as Nigel said, furloughed employees are permitted to take part in the consultation process that doesn't constitute work, and employers and trade union reps can act as the accompanying person without that constituting work. So there's no reason why you have to wait until the end of the scheme before commencing consultation. And permanent changes, You might want to consider making permanent changes to contracts or ways of working, introducing new shift systems, reducing hours or overtime rates, removing some benefits. Any changes to fundamental terms obviously have to be achieved via consultation and agreement. You can't unilaterally make them. So again, set out your business reasons for needing to make the changes and consult with your employees. You may already have agreed some temporary pay reductions, particularly for your high-paid employees. Consider if you want to ask them to agree this to being extended for a period of time. Weigh up against the goodwill in having agreed to it already, with the understanding that they would be returning to full pay. Similarly, you may want to now introduce reductions in pay on a permanent basis. Again, consult with your employees and gain their agreement. Remember that unlike the furlough scheme, you can't take employees below the national minimum wage, national living wage, even with their agreement. As we said, it's unclear what the new normal will be, but certainly the way in which we work will be different. The crisis has shown us we can work in different ways. Work doesn't have to be done within certain times. Travel isn't always necessary. So take this ideal opportunity to build on what has happened and recognise that there are more agile ways of working. You may well see an increase in flexible working requests. Don't reject these out of hands. Consider if in fact your employees can work more effectively in different ways and at different times. But still consider the emotional and social side of work for people. Whilst many have been working at home, this was out of necessity rather than as a planned HR strategy. People were doing the best they could in the circumstances, often without access to all the required technology, certainly without suitable working space or furniture. And it doesn't suit everybody to work from home, particularly younger employees. They may still live with parents or in shared rented accommodation. And don't underestimate the importance of human contact. People are going to emerge from this crisis desperate to get back to a shared workplace. But yes, certainly consider more flexible working, continuing to use Zoom, Teams where appropriate to reduce travel. But remember, not all meetings should be conducted remotely, and anyone who has had to carry out a disciplinary hearing or redundancy consultation meeting via the phone or via a video call will appreciate that is not ideal. And finally, value your employees and treat them accordingly. The organisations who care for their employees will see rewards in terms of loyalty and motivation. A bit like the question, what did you do in the war? How did you treat your employees during COVID-19? It's going to be a question that is asked in the future. And we've all seen the negative press around Sports Direct and British Airways. You need to focus on the economic side of your business. Don't allow the human aspects to be forgotten. And consider the impact of your actions on your brand and your reputation. Okay, I shall hand you back to Nigel.
That's marvellous. Thank you, Stephanie. And a lot there to think about, but obviously that was the point. It's just to sort of flag that there was a lot of considerations in relation to as we move forward and try and get back to reopening businesses and thinking about what the new norm looks like. So I'll now hand over to Greg to cover the funding.
Thanks, Nigel. Morning, everybody. So we're going to look at the three main government funding schemes and then also look at what some other funding options might look like as businesses begin to be unmothballed and start to reopen again. So in terms of the government funding schemes, so we'll start with CBILS, which was the original scheme that the government announced all those many weeks ago now. So that is for funds up to £5 million for businesses with a turnover of a maximum of 45 million. So if I'm honest, this particular scheme is the one that's had the most issues. It still is very bureaucratic in nature. I'd be very keen to hear from any clients or even non-clients who are having issues or been rejected. There are plenty of other lenders now added to that scheme rather than just the high street banks, and we'd be keen to talk and try and help you guys to achieve what you need to keep the businesses going. The paperwork involved has become very convoluted, as I said. The government have now removed the requirement for the forecasting element on CBILS. You don't have to put the forecasting in. I have concerns about removing the forecasting and simply allowing the banks to look at their backward-looking tests, which I think will lead to more rejections purely as the starting point is the 2019 accounts. And hence, I still believe it's imperative that we put together some sort of business planning and cash flow forecasting moving forward on CBILS for the reasons we've previously outlined. This will be even more important when we're looking at the CLBILS, larger loans further down. Of the main banks, definitely NatWest seem to have coped best with the CBILS scheme and seem to be getting money out the door pretty quickly. We've had a number of clients with some good successes. The rest of the banks are really much of a muchness, to be honest. A couple in particular I would mention. Barclays, we seem to be having some issues around additional security, tangible security being required on every application, regardless of the amount. That is one certainly I would look for if you're dealing with Barclays. In terms of new lenders, so recently added to the CBILS scheme, Funding Circle, 1PM, which is a big asset finance business, Paragon Bank, Starling Bank and AIB. There was a host of others added just yesterday, which includes Investec Bank amongst those. So again, there are lots of lenders now, well over the original 40 that were on the scheme. And again, happy to talk to anybody that was still looking to put an application forward or has been rejected. In terms of the CLBILS, the larger scheme, we got some interesting feedback earlier in the week from some clients saying that Clydesdale in particular was saying that this scheme wasn't open yet and that they were waiting for further clarification from the British Business Bank. It is open. Applications are being accepted by all the major banks. Again, process is slow in getting through the paperwork and going through the various stages of the scheme. But money has gone out the door for some of these larger loans. Remember, this is for businesses turning over between or over 45 million up to 500 million in turnover. You can put forward for a loan a maximum of 50 million. All accredited lenders on this scheme only offering this to their own clients. It's a much more smaller list of lenders that are open for this particular scheme. And clearly onboarding a client that turns over more than 45 million for a bank at this point isn't really feasible. So I get why that they have limited it. But again, if you're looking for finance in that area, certainly myself or Laurence will be able to help you with the forecasting, with the process, and talk you and walk you with you all the way through it to give you the best results. NACFAB, the National Association of Commercial Finance Brokers, recently released some research they've done which showed that you are 33% more likely to be accepted on one of these government schemes, the CBILS or the CLBILS schemes, if you go through a professional advisor. So there is definitely some benefit in doing so. On the smaller scheme, the recently announced Bounce Back Loan Scheme, this scheme really does appear to be working very well. Money going out the door pretty much next day. Clydesdale and HSBC, you'll see there's some running themes here. Notable exceptions again, I'm afraid, where many clients that applied on Monday still hadn't heard as of yesterday anything from them. But now I understand that is being rectified and those are starting to move. NatWest on this particular one, we've heard from a few clients that they have been asking for additional information outside the criteria set by the government, but are still turning these round same day, and Lloyds are working on a next day basis. Accredited lenders on this scheme at the moment is a little bit broader. HSBC, Barclays, Lloyds, Virgin Money, TSB, Santander, Bank of Scotland, NatWest RBS, with others coming on board very shortly, including Starling Bank. At the moment, your only option, if you were not a client of those mentioned, excluding Starling because they've not been added yet, is HSBC, who will accept non-customers. Everybody else at this point only dealing with their own clients. So that's a walk through those three schemes. In terms of additional options, as we look forward to what's going to happen when Boris makes his announcement and finally lets me out of the house, I think that you are going to have to, a number of businesses will have to look at some further finance options as you start to get the working capital up and running of the business again. Some businesses have been fully mothballed, some have been 3/4 mothballed, and for some people it's going to be almost like starting again. So the working capital is going to come into effect, and you're going to need to fund at least that initial stage of the working capital. So a couple of options that we would look at. Invoice finance is one option that we can look at. Unlocks invoices as you start to generate invoices, gives you a percentage of those invoices up front, allows you to use asset that's already in the business on a working capital basis to provide more cash, improves cash flow, but you can also use it. It's a very cost-effective way of doing the credit control, and cash, particularly in the next 4 or 5 months, is going to be king. I'm sure Georgina, when she does her bit, will echo that. Cash is going to be king at this point. So in terms of trying to get paid as quickly as you can, that's going to be really key for most businesses. It's also very flexible, so you don't have to do it on a basis of giving the invoice financer all your turnover. There are lenders out there that will do it on a selective basis, allowing you to pick and choose debtors that you can give them to just give you enough working capital to get that business up and running again without tying you into long contracts, etc., etc. And again, happy to talk to anybody that wants to look at those options or understand some more. Another quick one that we would highlight finally is RCFs, or revolving credit facilities. Like an external overdraft is the best way of looking at it. So it's separate from your bank account. It lets your business untie cash tied up in unpaid invoices, again, stock and or work in progress. So they look at those, they take a debenture over the business, they look at those 3 particular sections and provide a percentage against each of those to give you an overdraft limit that you can borrow against. You have access to the line of credit that works much like an overdraft. Once you have your limit, you can draw down funds and make repayments as often as you like, and all you have to do is service the interest, so you don't have to make a capital repayment in the month. Draw cash, repay as often as you want, and that's a really, really, really good way of having an in case of need facility, just in case you have a cash flow issue. If the business starts really quickly and you're over trading, or if it's a little bit slow and you need to, a little bit more cash, clearly going back to the bank for another loan after taking a CBILS is going to be tough. May cause the bank to want to renegotiate your CBILS loan. So if you've got those particular issues, we'll be happy to talk to clients and see if we can find a solution that's individual for what you need. And that's all that I really wanted to say. So I will hand on to Laurence.
Thanks, Greg. Yeah, I'd like to spend some time now giving you a flavour of some of the key factors you need to be thinking about if you're considering raising equity finance rather than debt. And I'd also like to provide some meat on the bone regarding the recently announced 250 million convertible loans fund scheme, the Future Fund that the government has announced. So firstly, just starting with equity finance, some of the key considerations if you're considering that as opposed to looking to get debt. One of the first key considerations is the cost. Equity investors are at the bottom of the unsecured creditors list if a business runs into difficulty. So they will expect a higher return for the higher unsecured risk that they're taking. Over the lifetime of the investment, this return can be anything between 2.5 to 3 times their initial investment, which can equate to somewhere between 20 and 30% return on an annual basis, which is clearly much higher than the cost of secured or in fact even unsecured debt. Another consideration will be the current debt levels that you already have in your business. Existing financial covenants may restrict the raising of more debt. And if you do need to raise more money, then equity may be the only real sensible route available to you. In terms of growth profile, it's important. Businesses with higher growth prospects are far more attractive to equity investors, as they will offer those investors the best chance of the high returns that we mentioned a few moments ago. Also, future exit options. Equity investors ultimately want to realise their investment, so their needs at the outset really to be in alignment of thinking with the existing shareholders on exit strategy and timings. The duration of the funding will also play a factor. Equity is generally a longer term funding source than debt, and it may therefore actually suit some business owners who have longer term growth and investment plans for their business. Asset profile will also be looked at. Businesses with less robust tangible asset bases lend themselves far more to raising equity than to raising debt. And similar with regard to cash flows, similar businesses with lumpy, less predictable cash flows will also lend themselves more to raising equity and debt. They will be more attractive effectively to equity investors than possibly to debt lenders. Repayment flexibility for owners of businesses is also important. Equity related payments are invariably more flexible than debt. So, for example, dividends can be withheld, but interest and capital on debt invariably can't without breaching lender financial covenants. Also, as an owner, operational and strategic support may be important to you. Some owners will welcome the expertise that an external, highly experienced equity investor can bring to their business over and above the pure funding that they put in. However, clearly on the other side there's a question of control. Equity investors will want to protect their investment, and they will do this by the use of a number of mechanisms like enhanced voting rights, ratchets, drag and tag along provisions, and other high-level operational restrictions. So if as current owners you want to retain total control of your business, then equity really isn't going to be the route for you. So that's an overview of some of the key considerations when looking to raise equity funding. What I'd now like to do is to move on specifically to the future fund. I may just have a quick swig of water, if I may. Thank you. So last month, the Chancellor announced the introduction of a 250 million convertible loans fund, the Future Fund, which is being launched this month. The scheme will initially be open until the end of September and will be delivered in partnership with the British Business Bank. The fund appears to be more generous than similar schemes that have been introduced in Germany and France. The loans will be a suitable option for business owners who are receptive to third-party equity investment, and we've already touched on some of those considerations above, and or whose businesses may be unable to access the CBILS and the bounce-back debt facility schemes that Greg's already spoken about. Some of the small print around the Future Fund is convoluted, but the headline terms are as follows. Firstly, eligibility. To be eligible for a loan under the scheme, a business must be an unlisted UK registered company that has raised at least £250,000 from private third-party investors in previous funding rounds in the last 5 years. And also the business must have a substantive economic presence in the UK. Don't meet those criteria, the Future Fund will not be eligible to you. There may be other equity options that are open, but not the Future Fund. The government shall make unsecured funding available alongside other third-party matched investors. So this means that the government loan shall constitute no more than 50% of the aggregate funding that is being provided to the company. In terms of the loan size, the minimum and maximum amounts provided by the government to the company shall be £125,000 and £5 million respectively. There shall be no cap on the amount that the matched investor may loan to the company. So therefore, there's no cap on the aggregate funding that can be provided, aggregate being the government funding plus investor funding. In terms of what the funds can be used for, they must be used solely for working capital purposes, which could sit along raising some debt along the lines that Greg touched on as well. You may wish to raise some debt and some equity for working capital. The funds shall not be used by the company to repay any current borrowings, to make dividend payments to shareholders, bonus payments to staff or management or external consultants, or to pay advisory fees to external advisors. The interest rate, well, the government shall receive a minimum default return of 8% per annum, which is to be paid on maturity of the loan. And the loan itself shall mature after a maximum of 36 months if it hasn't been repaid. In terms of the conversion of the loans into equity, the terms and conditions are quite complicated. I'll just touch on the headlines, and obviously if anybody wants to understand this further and have an off-the-line discussion with myself, then obviously very happy to do that. The funding shall automatically convert into equity on the company's next qualifying funding round. On a non-qualifying funding round, the funding shall convert into equity at the election of a majority of the matched investors. A qualifying funding round shall take place where the company raises an amount in equity capital that is equal to at least the aggregate amount of the funding. A non-qualifying funding round shall take place where the company raises less in equity than the amount required for a qualifying funding round. I did say that it was a little bit convoluted. On a sale or a listing, an IPO of the business, the funding shall either convert into equity or it shall be repaid with a redemption premium, whichever is the higher amount to the government. On maturity of the loan after 36 months, the loan shall, at the option of a majority of the matched investors, either be repaid by the company with a redemption premium or it will convert into equity, unless the government requests repayment in respect of its loan. In terms of conversion on a conversion event, the loan shall convert into the most senior class of shares in the company so that the government won't be negatively affected. In terms of ongoing day-to-day company decision-making while the loans are in place or after their conversion into equity, the government shall have limited corporate governance rights as a shareholder, or as I say, while it still retains the debt. So it won't be able to totally control your business on a day-to-day basis. The company's owners will have to provide limited warranties in respect of title and ownership of the shares in the business, the company's loan eligibility, and the company's compliance with the law, adherence to its borrowing facilities, and also litigation and insolvency events on closing of the loan. And in terms of covenants, the company shall also provide limited covenants to the government, including undertaking to treat the government fairly and equally, and to provide it with the same information rights as other investors in the company. In terms of other loans, while you have these loans outstanding, the company shall not permit the creation of any indebtedness that is senior to the government loan, other than bona fide senior indebtedness from a person that is not an existing shareholder or a matched investor. Transfer rights. The government shall be entitled to transfer the loan or its shares without restriction to an institutional investor, although there is a little bit of additional small print around that. And in addition, the government shall be entitled to transfer any of its shares without restriction within the government and to entities that are wholly owned by central government departments. Just some other sort of commercial points around the fund. The fund's structure, as I have said, is only available to businesses that have already been backed by VC houses. It has been reported in the press that there are about 13 influential figures in the world of tech and investment who've helped to devise the scheme with the Chancellor, and that all of these people are men. So some are arguing that this new scheme is merely an old boys' network. I can't really comment further on that. Hence, the scheme, however, could prove to be harder to access for those who tend to receive less support for business funding, such as women, ethnic minorities, and those with businesses outside of London. That obviously remains to be seen. More broadly, some feel that there should be no obligation on taxpayers via the government to fund loss-making businesses specifically and start-up businesses generally, given that sadly around 75% of them do actually fail. And some also worry that innovative startups will be held back by a government shareholder whose appetite for risk will, of course, probably be lower. So if the fund is appropriate for you, or if you are seriously considering equity investment, then what you would need to do is to put an investment document together. This document will sell the business to investors with positive messages, laying out all the realistic plans and objectives of your business. There are a number of key things to include in such a document, and I'll be happy to discuss that further with anyone offline if you want to get in touch. Finally, what else can an equity investor offer you? If you're at that point where you're moving ahead, as part of your decision-making process, don't be afraid to ask equity investors what they can offer the business over and above the funding, so that you can assess the chemistry and the likelihood of being able to work together for at least several years and possibly longer. So here are just some of the key pointers that you should really be asking equity investors before you make your decision. One is, what strategic and operational support can they provide to you over and above the funding, and at what cost? What access do they have to a wider network of contacts in your existing or target markets? What access do they have to MBI candidates who could come in and supplement your incumbent management team? What channels exist to meet with some of their other portfolio companies so that you can tap into sales opportunities and also share best practice? What further funding do they have available for M&A and other growth requirements, such as working capital, capital equipment, and new premises? And finally, what's their ideal exit timetable? Because they will want to get out at some point, and so will you. If you get through all that and you're still keen to proceed, then the next stage will be the due diligence and the detailed transaction documentation process. But for the purposes of this webinar, I'm going to finish now. Suffice to say, I'm very happy to talk offline with any parties interested in discussing this topic further. Thanks for your time. And I think I'm now handing over to Jay to discuss R&D reliefs and other stuff with regard to R&D. Thank you.
Thanks, Laurence. First of all, good morning and thank you for joining us. With R&D tax reliefs, you may or may not have heard about the schemes. Within this session, I'll cover three basic points. The first one being, what is R&D tax relief? How is it relevant to your business? And the second being, what's going on with the schemes right now with relation to the R&D tax relief, with the coronavirus business support schemes that are ongoing, because there is some interaction there. And what does the future hold for your business in terms of activities that you might be doing to respond to the disruption enforced by the lockdown? So very, very briefly, within every developed economy, including China, India, all of these economies compete for essentially allowing SMEs especially to conduct very, very high value work. And what they classify as high value work is, if you think about the DNA of your business, what is the value proposition that you're offering? You might be providing a service, so developing a piece of software that facilitates HR, for example, or you might be a baker, you might be a chocolatier, or an engineering company. The scope is very high. Whatever you develop, when you essentially problem solve using a piece of technology or engineering, you're creating value. And big studies have shown that in the UK, for every £1 of problem solving work that you do to develop new technology or new knowledge, essentially results in £3 worth of value within the economy in the supply chain. Now, essentially the UK government looked at this 20 years ago and established the R&D tax relief schemes, and hence it's celebrating that anniversary this year. It's quite a mature scheme. What the R&D tax relief scheme does is it's essentially it's essentially two schemes that work in parallel. The first one is R&D tax relief. The second one is patent box. I'll touch on R&D tax relief first. So R&D tax relief looks at what your teams are doing in terms of developing value, and it's retrospective in nature. So HMRC allow you to go back a maximum of 24 months from your latest financial year end. So if you've had a year end in May 2018, the deadline to submit an R&D claim for that year would be the end of this month. It's quite a generous time frame that they allow you to go back. Essentially what happens is we look at the activities that your company did within that period. When I'm talking about R&D, just before I continue, I'd like to sort of interject there and say this is not R&D in the classical sense that you may think. This is, I would like you to replace R&D with problem solving. So this is not necessarily something that happens in a laboratory environment or in a very formal scientific environment. This is something that your teams could be doing through discussions, through spreadsheets, calculating different things, and of course experimentation. So within that 24-month period from your latest financial year end, if your teams have been doing such problem-solving activities, it is likely that they would qualify. If your lead technical people are scratching their heads and going, okay, when we try to develop this product or service, they would know what would be capable at an industry level. And because your company is trying to develop a better niche, or maybe it's trying to become more productive, you're doing that work to create value, and hence that work is worth something. Now, the reason why governments do this is because they want to. The reason why various economies around the world have R&D schemes is because they want to reward companies doing it. In the UK, within that 24-month period, whenever we look at the activities that your company has engaged in, that is tied in with costs. So your company incurs costs while doing that work. The types of costs that qualify are your staff salaries, payments for gas, electricity, utility bills, or payments for prototypes, experimental work, consumables, basically. The other one is payments to specialist subcontractors. So you might not have all the expertise under one roof. You might engage a specialist subcontractor to give you a piece of work as you task them to do something, or you might employ agency workers. That's the fourth category. And the fifth one is payments for software subscriptions. So you incur these 5 types of costs in trying to do that work. So what we do is we examine what those activities were, we structure them, and we talk about the challenges that your team overcame. It does not matter whether your work was successful or not. What does matter is that you tried. And as a result of trying, you experimented, you modeled, you discussed, you argued with each other, and some new knowledge has emerged out of it. And as a result of that activity, the business incurred a cost. So within the scheme, for every £1 of cost that the business incurred, if you're an SME, if you're profitable, you will get 25p for every pound. If you were loss-making, you would get up to 33p on the pound. You are recognized as an SME if at a group level you have less than 500 employees, or less than 100 million euros turnover, or less than 86 million euros on balance sheet assets. So that is essentially twice what the EU has. But the UK government argued that the cost of doing business in the UK is also twice as high. So they want to include more companies in the lucrative SME scheme. In parallel to the SME scheme, you have another one running for larger companies that are above those thresholds, called the Large Company Scheme, and its acronym is RDEC, actually. So it's R&D Expenditure Credit, and that's much less generous. You only get 10p on the pound, and you cannot claim for subcontractors. So the issue is that the SME scheme, because of its generous nature, the EU have deemed it to be state aid. Now, as Nigel said, although the job retention scheme is not recognized as state aid, and Greg and my colleagues have highlighted throughout the session, there's various forms of support coming in from the government. You need to be careful about the interaction of these coronavirus business support schemes with R&D, because, for example, if I claimed coronavirus business interruption loan or a bounce back loan, and I used that to fund the salaries of my staff, or prototyping work or problem-solving work, for the claim that I'm going to make in my current financial year for these months, essentially, you can't have 2 pieces of state aid that subsidize the same piece of work. So the SME is already state aid. The coronavirus business support schemes are recognized as state aid, as the loan scheme and bounce back loans. So unfortunately, would have to push those projects into the less generous large company scheme, where you only get 10p on the pound rather than 33 on the p on the pound. So you need to be careful if you are engaging in those business support schemes. If you have claimed coronavirus business support, it's and also you have claimed R&D or thinking of claim R&D, it's not the end of the world, because you can declare that the business support scheme, the business support funding that came from the government did not subsidize R&D activities, that you suspended R&D activities while the lockdown was taking hold. And once the lockdown was lifted and your business was standing on its own 2 feet, essentially you were funding those R&D activities by yourself. So that gives you an overview of the R&D tax relief scheme, which is retrospective, and its interaction with coronavirus business support. And essentially, with coronavirus and the lockdown, your business might have to re-engineer the way it works. So if you're a food business, what I've heard from a lot of our clients is, oh my God, the way we were envisaging food to be packaged and distributed has to completely change now. We have to take that into account. If you're a construction company, for example, your operatives need to maintain the 2-meter social distancing guidance on site. And the problem is that might not sound like a technical requirement, but if you think about it, your operatives completely need to change the way they behave, the way they operate. And if you integrate all that together, that's going to result in an engineering problem. How do you get that project done within a specific scope of time and cost and deliver it to quality? So there's going to be some problem-solving activity that gets instigated because of the lockdown, and it would be interesting for you to note down what those were. HMRC is not interested in coming down and looking at, auditing you for R&D activities unless you've done a really wrong claim. What they are interested in is that you've maintained a reasonable and fair record of the activities that you were doing and the costs. So it is a marriage between the technical and then assessing how intense that was and then applying that to the costs. As I mentioned earlier, just very quickly, the other scheme that runs in parallel to the R&D tax relief is Patent Box. So Patent Box is the opposite. It looks to the future. So if you are interested in essentially applying for patents, we work with partners that are disruptive within the industry. So they're able to get you patents for 1/3 of the cost, typically. And how Patent Box works is, for example, if I establish a patent this year, I can apply for Patent Box such that any future revenue that is realized from that patent gets taxed at a 10% rate rather than 19%. And hence, that's quite an advantage if you're expecting quite a lot of revenue from a particular patent. Just a caveat around that is you can't just go shopping for patents as bigger companies do. You have to show that you've undertaken some development on them. And like with all my colleagues, there's no harm in asking any sort of question, getting in touch with us. We're more than happy to help. And I will now pass on to Georgina Eason. Thank you very much.
Thanks, Jay. Hi, everyone. My sector is going to be relatively short. I'm one of the partners in our restructuring team, and it's just a brief overview of some of the changes that the government have made which affect our world. The changes mainly revolve around actions that can be taken by creditors and insolvency practitioners during this period. The main one, which you probably would have heard about, is wrongful trading and its suspension. Wrongful trading, the definition is basically directors who continue to trade when they knew or ought to have known that there was a reasonable prospect of avoiding insolvent liquidation. The upshot, if you're actually found guilty of wrongful trading, is that it sort of pierces the corporate veil, if you like, and directors can become personally liable for debts incurred within a certain period of time, which is obviously extremely onerous on directors of a business. One of the ways to minimise the impact is to ensure that you take every step to reduce potential losses to creditors. However, as it was causing a massive amount of uncertainty amongst directors and advisors like us in terms of what directors should be doing if their business is potentially insolvent at this time, the government has suspended our ability to challenge directors or to take an action in respect of wrongful trading. That applies retrospectively from the 1st of March, and the initial period is for 3 months. The government may look to extend that. But I think the important thing to note is the government have focused on the suspension of wrongful trading, but it hasn't actually suspended any of the other powers insolvency practitioners have to look at with regard to challenging directors or transactions or decisions that have been made when the company is potentially insolvent. So there's still liability for fraudulent trading, and directors can still be disqualified. Obviously, this remains in place to stop directors effectively trying to take advantage or carry out any wrongdoing. It's yet known if this will give boards of directors the confidence to continue to trade amongst such uncertainty, or whether they'll take action and put companies into a process. I think the peak in terms of insolvencies, liquidations, administrations is yet to come and is probably months down the line. So it's really key that all the checks and balances aimed at directors fulfilling their duties remain in force. And also key to note that obviously where a company is potentially insolvent, the duty of a director switches so that you must act in the best interest of the creditors, as opposed to usually where you'd be looking to ensure that you're benefiting the company's shareholders effectively. There are still other actions that we can take again for breach of fiduciary duty or misfeasance, so that's any other kind of wrongdoing. The scope for this application is extremely wide, and there's no indication that other offences will be suspended. So it's obviously critical to take advice at this time if your company is potentially insolvent and you're looking to continue to trade. The government has made some more changes recently, and they've announced that they're going to reduce the ability to the creditors to issue statutory demands and winding up orders. Is particularly relevant to landlords, so they can't issue statutory demands for payment of commercial rent, for example. It's trying to obviously protect tenants, and particularly relevant to the high street. And we've seen a number of the well-known retail brands entering into company voluntary arrangements and administrations. So this is just to have that sort of, again, 3-month period at the moment of a sort of impasse. Evictions also can't be carried out, and it's unlikely that possession orders will be made in relation to insolvency practitioners getting possession of properties and being able to sell those properties. So it's effectively halted a lot of appointments for insolvency practitioners, with compulsory liquidations and bankruptcies not being made at this time. Just to give you an indication, you would usually see about 200 orders being made in a week. I think last week it was around 35, and I think the list for next week is around 7. So during this time, courts are loath to continue to make orders and just sort of give companies that breathing space really to explore some of what we've heard about on this call, as in obtaining loans to enable the company to continue, looking at VAT deferrals, and the other steps that are available in relation to obviously government funded wages, furlough scheme, etc. So I think it's just the key thing to note really for directors is during this time, the practical things that you can do. The key one is to record the decisions that you're making. Why are you making that decision? And I think Greg referred earlier to looking at your cash flow, looking at forecasting. You should be ensuring that if you're looking into taking out a loan and there's repayments that will be due, even if that's within after a 12-month period, that the company will be actually able to service and meet the demands of those loans in a future period. Otherwise, effectively, you're just kicking the can down the road and creating a problem further down the line. So at the outset, it should be addressed insofar as it can. But holding the regular board meetings, albeit they may not be physical board meetings, but by way of video conference, telephone call, whatever your articles allow, and just recording those decisions, and more important than ever to keep minutes of those meetings. So that's it really. I suppose the thing to take away is seek advice and record your decisions as to why you've decided to proceed along the particular route that you've chosen. There is the intention to put in further measures, and I believe the government are looking at that sort of middle of May, so no doubt there'll be further announcements. But for now, that's it. Thank you.
Thanks, Georgina, and thank you to all of our speakers. I mean, we've pretty much kept to time, so thank you to everybody. There was a lot there. I'm sure you'll understand, because there's a lot to think about. We're going to move to essentially a new norm, and as I think as some of the speakers have touched on, that phrase in terms of almost starting again. So this is quite unprecedented. There's a lot to think about. And we've sort of tried to cover quite a breadth of that and some depth to help you to start thinking about what the next steps are, what planning you need, what some of the opportunities and pitfalls might be. Thank you to everybody for joining this webinar. A recording of this will be available and will be sent out as soon as it's available. So thank you, everybody. And our next webinar update will be in 2 weeks' time. But if you haven't already, please visit our website, because there will be, I'm sure, some updates coming out between now and the next webinar. And we have a sort of COVID-19 webpage set up with the advice to date. And I'm sure that will be some useful updates coming through in the next week to 10 days as well. So thank you, everybody, and goodbye.